Alright, for this video I want to go over how to prepare a sample Form 5227 for a split interest trust return. So the 5227 could be filed for a lot of different types of split interest trusts. In this example, what we're going to look at is a Charitable Remainder Annuity Trust, or CRAT, C-R-A-T for short. So we've got the full return here. We'll go over it page by page. In addition to this, I do have a sample consolidated 1099 that would be issued from the broker. So we'll look at the investment income on this page. And then we do have a sample, or not a sample, but I put together a very simple Excel workbook that shows some of the elements that we're going to need to prepare the return and the K1. So we'll get into these in a bit more detail later. And then lastly, I do have two slides here covering some background on charitable trusts and then the fact pattern itself, and then some more details on the return and what we kind of need to look out for when we're going through the prep. So what are some of the highlights just to kind of get our baseline here with respect to charitable remainder trust? So charitable remainder trust, not to be confused with charitable lead trust. So those are CLTs. These are charitable remainder trusts, which means that the beneficiary that's receiving the income payment over the course of the trust, that is the non-charitable beneficiary, and then the charity gets the remainder of the assets at the expiration of the trust. So what are the two main trusts that we think about when we're looking at CRTs? We have our remainder annuity trust, which is going to be this example, and then we have a uni trust, so a charitable remainder uni trust. Now there's a lot of other different types of uni trusts. You have the net income CRTs, you have the net income with the makeup provision CRTs, flip CRTs, but again, in our example here, we're just going to be looking at the CRATs here. Now, when we say split interest, what do we mean by split interest? We mean that this trust is going to provide an annual payment of income to a non-charitable beneficiary for a term of years, and then at the expiration, one or more named charitable groups are going to receive the remainder of the assets. So that's what we mean by, quote, split interest, is we have one beneficiary that is non-charitable, so let's just say an individual, right, that has to pay tax and do all of that. And then the second beneficiary here, two or more, are going to be charitable groups. So that is the split interest language that we assign to this. Now, when we look at CRATs, so these are the annuity trusts, that requires a fixed dollar amount paid to the income beneficiary each year. And the dollar amount is fixed regardless of whether the evaluation of the assets go up and down. So if investment performance is really good, it doesn't mean that the income beneficiary gets more money. Right? Now, in contrast, the CRT uses a fixed percentage of the assets and it's revalued annually. So with a CRT, the amount of cash that actually gets distributed to an income beneficiary does go up and down, right? Because it fluctuates with the value of the assets that are within the trust. Now, once the CRAT is funded, additional contributions cannot be made. So in our example, what we're going to see is John Smith sets up the trust, puts in $1 million. Once that thing gets started, John cannot put in additional property, right? It's closed off. CRTs, different story, right? CRTs are allowed to accept additional contributions. Now, here's what's really, really important to remember. When we look at remainder trusts, so CRTs, these trusts are generally exempt from federal income taxes unless they have UBTI, right? Now, in contrast, the charitable lead trusts, right? So the charitable lead trust is where the charitable party gets the income payment, right? They get a payment every year, and then the remainder goes to a non-charitable beneficiary. Those trusts are subject to federal taxes. So CRTs, we only have to file the 5227 generally. With a CLT, so a lead trust, you're filing the 5227 and you're filing a 1041 because you still have the trust subject to income taxes. So let's look at the fact pattern that we have here, and then we'll dive into this trust return and start looking at some of the key pieces. So in our fact pattern here, we've got John Smith on March 15th sets up this CRAT, and he funds it with $1 million in cash. Now, the trust document provides that there's going to be annuity payment of 6% of the initial fair market value of the property contributed. So $1 million in cash, 6% is $60,000, right? So the annuity payment of $60,000 is going to be paid to the income beneficiary for a term of 10 years, right? Equal quarterly installments at the end of each quarter. The non-charitable income beneficiary is going to be his son, who's currently 30 years of age. Now, the remainder interest, so the charitable remainder interest, is held by this Florida charity. So let's just say Medical Charity, Inc., which is a 501c3 charitable organization, right? So that's good. So we've got the non-charitable income beneficiary. We've got the charitable remainder beneficiary there. Now, once the $1 million is put in, it's just invested into publicly traded stocks and some bonds. So that's important because trusts do have certain kind of limitations on what it can invest in, right? So, for example, they don't want to be investing in something that generates UBTI because that would be subject to tax. So always things like that to keep in mind. Now, during the first year, the total annuity payment that went to Adam was $47,836, which is the prorated amount of $60,000. So we'll look at this computation later, but when you have a short year, so not a full calendar year, you prorate the annuity payment to account for not having a full tax year, right? And so we'll look at that in more detail later. Now, on the expenses side, the trust had some legal, accounting, and trustee fees, about $3,200. And then when the trust looked at its 1099, it sees that it has gross investment income of $48,465, which comprised of interest, dividends, and some capital gain earnings. All right, so this next slide here, I'll flip back and forth between the return and this, just because I'm trying to highlight some important things to remember when going through these. And so when we get to those parts of the return, I'll come back here. But if we look at paragraph 1 up here, section 1, just some of the, again, key points, right? So CRTs, that's what we have here. Charitable Remainder Trust, that's an annuity trust, generally exempt from federal income taxes. So we're not going to be doing a 1041. We're just doing the 5227. Now, when you look at the 5227, there's a lot of different parts, a lot of different sections. Not all of them apply to you, right? What you'll see is that charitable remainder uni trusts have to do certain parts, but the annuity trusts don't. If you have a lead trust, they complete different sections. If you have any kind of self-dealing issues or jeopardizing investments, maybe you've got to do a 4720 as well for some excise taxes. So a lot of things to just kind of be on the lookout for with respect to what kind of activities are going on in your trust, who's involved, and what you have to do on the return. All right, so let's look at the return, and we'll start to look at the income information later, but let's get some of this header stuff out of the way first. So we've got the full name of the trust at the top here and the tax ID number for the trust. So the trust is going to need its own EIN in order to file this return. The name of the trustee, so we're using Not Real Trust Company Limited, based out of St. Pete. And in the type of entity, we have indicated in box 2 that this is a charitable remainder annuity trust. All right, so it's not a charitable remainder uni trust, right? We don't have a fluctuating amount because the percentage is based on assets. We have an annuity trust that is very clear in the trust agreement, and we don't have a lead trust, right? This is not a charitable lead trust. It's a CRT. It's a remainder trust. All right, now, in box F, we've indicated yes here, the checkbox for initial return, and the date the trust was created, so March 15th, 2022. And then boxes D and E, we can come back to these later. You should disclose the fair market value of the assets at the end of the year. And so this number, we'll see this matches with our balance sheet. So after we do the balance sheet, you'll recognize that figure. And then the same thing with after we populate the income information, we could see what the gross income is for the year. All right, so let's get into sections A through D and E as well on the income and the deductions. So if we look at the 1099 for the trust, these should be familiar for anybody that has a brokerage account, right? You get a brokerage account that shows, okay, what is the account holder name and tax ID number and address, and then what is the investment income earned in the account during the year. So we've got $31,000 and change of ordinary dividends, of which $21,006 is qualified. So the difference there is the non-qualified dividend portion. We've got some interest income down here, and then nothing unique on the other elements. So we don't have any foreign taxes paid, so we've got no foreign dividend income or foreign interest income. No exempt interest dividends, so we're not investing in any kind of municipal bonds or RICs or anything like that. And then on the second page here, we've got the summary of the short-term capital gain and loss transactions. So we sold, let's just say we sold one stock, so we had the proceeds, the cost basis, and then we've got our realized short-term capital gain for the period. All right, so use this information to help prepare your trust return. But what I often see is a lot of trusts will have multiple brokerage accounts because they have different investors, and so you're going to have to consolidate a lot of this information. But in this example, we're keeping it very simple. We've just got a little bit of investment activity, one account, nothing else going on, so it makes our lives a little easier. So we've at the top here for box 1, we've got our interest income of $83.51. There we have our total ordinary dividends, and then the portion of which is qualified, $21,006. And then in the capital gains and loss section, we did complete Schedule D. Well, Schedule E first, right? So we did Schedule Form 8949, and then D. So we did the 8949 to show the sale of the stock, when it was bought, when it was sold. It's a short-term capital gain. And then ultimately that's reported up on Schedule D and then flows back up to page 1 of the 5227. So there we've got our 9102. So we've got our total, all our income covered at this point. Now in Section D, let's talk about deductions. So the trust is allowed to deduct any kind of expenses in connection with operating the trust, right? So things like trustee fees, if you pay attorney fees, accountant fees, tax return prep fees are deductible. So different rules than what you would see like on an individual tax return. Some things to keep in mind that are not deductible. So if you have any kind of tax exempt income, so this is a similar issue you would have if you had a 1041 for just a standard non-grantor trust. If you have any kind of tax exempt interest income, it remains tax exempt, but you have to reduce the amount of your deductible expenses by a pro rata share because they don't want you to kind of get the best of both worlds. If you got tax exempt interest, you have to reduce your allocable deductions by an appropriate amount. So that's something to keep in mind. Other things that we don't see as deductions that you would on 1041 would be things like the personal exemption. So these types of trusts don't get a personal exemption. These types of trusts also don't get a deduction for distributions to the beneficiary. So with a 1041, you calculate D&I. There's an amount distributed out to a beneficiary. The trust gets a deduction for that. Doesn't happen with this, right? Okay, so we've got our trustee fees, our attorney, accountant, and return prep fees are in there. So now in Section E, we have to allocate these expenses to the income amounts. All right, and so why do we do that? Well, because we want to reduce the amount of gross income by the expenses because that is going to be the amount of income that is distributed out to the beneficiary. And you certainly don't want to overstate what the income would be, right? So the lower the amount of income allocated to the beneficiary, that's what's going to help, lower the amount of taxable income that they have to include on the return. So, for example, if we look at the K1, we'll certainly come back to this in more detail, but the amounts that we see in interest, dividends, capital gains that's flowing through to the K1, we want these to be net of all the allowable deductions that we can take up here in Section E. So that's the purpose of this exercise, is trying to allocate the deductions to the different income categories. And then when we look at how much is distributed to the beneficiaries, we've already factored those in there. Okay, so I think this is a good spot to talk about tiers of distribution. So when a trust makes a distribution to the beneficiary, the cash or property that's coming out of the current and accumulated income starts with ordinary income and it works its way down through capital gains, non-taxable income, and then principal. So ordinary income is kind of like the first basket if you think of it in terms of that. And then once that is completely exhausted, then you move on to capital gains, and then on to tax-exempt income, and then to the extent that all that kind of income has been distributed out to the beneficiary, then you start to take away from the principal. And so that is really important to remember, because one, you have to be careful about how you allocate deductions to the income, but it's also going to really affect how the income beneficiary reports all this on their taxes. And so what I've done with this schedule here is try to separate out the different types of income and then allocate the deductions to each basket. So the interest income and non-qualified dividend income, these are the amounts that fall within that Tier 1 ordinary income basket. Qualified dividends would also be in that first tier, but that would fall after interest and non-qualified dividends. So if, for example, let's say that the distribution to the beneficiary, it wasn't the $47,000, it was only, $5,000. Well, the $5,000 would, or maybe a better example would be, let's say 20, right? So if it was $20,000, it would come out of interest and non-qualified dividends first, and then you would only start to kind of dip into the qualified dividend number. So you wouldn't even get to short-term capital gains or principal. All right, so think of it kind of like a top-down approach. So what we've done here is we've separated out all the ordinary income and the short-term capital gains amounts. So we've got the 39,363, which is the interest, qualified and non-qualified dividends, and the short-term capital gains. All right, so I've got those all separated here. And then I have allocated the deductions across each one based on a pro rata basis, right? So we've got the 3,200 in total deductions. It's being allocated across each of them just pro rata based on how much gross income falls within each basket. Now, you don't have to do it that way, right? What you can do, and what you're effectively supposed to do, is start with what would be directly allocable. So if you had an expense, let's say trustee fees, this wouldn't happen, but if you had an expense here and you could trace it precisely to just one of these types, you can allocate it to just that type of income alone, and you don't have to pro rata allocate it across the other baskets. Now, in this case, we can't really specifically identify the expenses to just one type of income, so it makes sense to just pro rata it across. So we've got $25.99 and $601 are the total expenses, so that's $3,200, and then we could see how it's just split up across these different types of income on a pro rata basis. All right, and so once you have those details, and then you can enter them down here on lines 24A and 25A. So line 24A, that's the total amount of expense that we're allocating to the ordinary income up here. Line 25A are the total expenses allocated to the capital gain income. And then 26A and B are blank because we don't have any non-taxable income earned within the trust. All right. Now, that is really important for the next page where we start to track our undistributed income for the period. Because remember, at this point, we really haven't done any work or as far as how much was distributed out of the trust or what that amount is. We're just trying to figure out what's the total amount of income within each category that we have, and how are we allocating those expenses across each category. All right. So once that's done, move on to page 2. So part 2, schedule of distributable income. So in this schedule, what we're trying to do here is track our prior year carryforwards of any undistributed income. Because this is a first year return, that line is zeroed, right? We don't have any undistributed income because we have no prior tax years. And then in section 2, we start to enter the current year amounts coming from page 1. So we have the line A for the ordinary income, our capital gains, and then our non-taxable income as we saw up here. Actually, let me just leave it like this so we can see it on both pages on the screen. So we've got in column A, it's asking us current year net income before distributions. Okay, this is the amount before we factor in any distributions to any beneficiaries. So in column A, asks us to enter the amount from part 1, line 24B, right? So line 24B, we've got a 36,764, and so that's going to go in column A here. Now, what's the difference between excluded and accumulated NII post 2012? There are two separate columns here because 2012 and prior, we did not have the net investment income tax. Right, so that's that pesky 3.8 NIT tax that individuals and certain trusts have to pay. And so if you have income or undistributed income from 2012 and prior, it can go in this excluded income column, which means that if it is, so let's say this trust was 15 years old and we had some undistributed income here. If you make a distribution from this bucket, it's going to be investment income to the beneficiary, but it's not subject to NIT. Because this trust was formed in 2022, right, well after the NIT issue, it's all in accumulated NII post-2012. So that's why we're using the post-2012 columns for both of these categories. So we've got the ordinary income in here, column A, box 2, and then the capital gains in column B, box 2, right? And then again, C, non-taxable income is left blank because we don't have any. Now, in part 3, distributions of principal for charitable purposes. None of that happened during this period. And the same thing for this section. We don't have any accumulated income set aside and income distributions for charitable purposes, right? The charity is the remainder here. So this isn't something that's going to apply under this fact pattern. Now, when we get to part 4, balance sheet, beginning year book value is 0 because this is a first year return. So we're only completing column B for the end of the year book value. Pretty straightforward, right? What is the valuation of your assets for book purposes? So cash, non-interest bearing accounts, savings and temporary cash investments. You know, if you prepare monthly, quarterly, or annual financial statements, you could pull these numbers off there. Or if you don't do formal financial statements, just look at your bank account statements, right? What is the cash accounts as of December 31st, year end? The investments in the corporate stocks and bonds, so we've listed those here. And no liabilities, right? So we don't have any liabilities or loans or anything like that from related parties. And then in the FMV column, the Charitable Remainder Annuity Trust don't have to do this, right? If you have a uni trust, you definitely need to do it, right? Because uni trusts, when you take that percentage, you're calculating it as of the FMV of the assets on a certain date. But in our case, we've just for completeness put it down here. I think it's helpful just to see the numbers, but obviously cash is always cash, no change in valuation there. And then there's the fair market value of the assets that we have at year end. Now, what's very important to remember for balance sheets with these trust returns, and the same thing goes for nonprofits filing 990s, you have to attach a statement and be very precise about what those assets are. So in other words, you don't just clump it together and say publicly traded securities. So we've got an attachment here that shows the positions. We only have one position in an index fund, one corporate bond. So we've just entered the exact name here, indicated it's listed at cost, right, on our balance sheet, apart from that fair market value column, and then the amount. All right. And then net assets, so trust principal or corpus. In our case, it's all principal. We don't have any undistributed income or capital gains or non-taxable income, and we'll see that later on when we look at what the uni trust amount is and how it chipped away at all those income amounts. So in our case, the trust principal is the total net assets, and we don't have any undistributed income amounts. Okay, so now if we go part 5 and 6, part 5 is the Charitable Remainder Annuity Trust amount. Right, now notice here that part 5 applies to a CRAT, but if we had a CRUT, we would do part 6. So part 6 would be completed for a CRUT, but we have a CRAT, so we're only doing part 5, and we can leave part 6 blank. So 1A, the initial FMV of the property placed in trust is $1 million, and enter the total annuity amounts for all recipients that was paid during the year. Now, the trust agreement said 6%, but we have an initial short year, so we have that prorated amount, $47,836. Now, Part 7, statements regarding activities. This is very important. So let me jump back to this slide here really quickly. We did touch on this briefly, but the 4720 excise tax return may be required if the trust engages in transactions with disqualified persons, has excess business holdings, conducts activities that jeopardize the charitable purpose. So you can't be engaged in lobbying or other kind of political activities for the most part. So that's where you might need to file a 4720. Now, this is where that section comes into play with respect to self-dealing, right? So split interest trusts generally treated as private foundations that are subject to these self-dealing rules. And so the trust agreement should contain a provision that says you cannot do this, right? You can't engage in self-dealing types of transactions, or it is covered under state law. So in Part 7 here, are the requirements of 508E satisfied either by the language in the instrument or by state legislation that governs this topic? And the answer is yes. So our trust agreement does cover these kind of issues, and so we've checked the box 1, yes. Question 2, are we using this to report income and assets of a segregated amount? So in our case, no. This would arise if you have a trust that can have basically a separate charitable remainder amount as a segregated account within another trust instrument. It's kind of difficult to explain, but it's almost kind of like having a side pocket investment within a trust. And so if you have a trust that has a lot of different unique assets, that's really what it comes down to. If you have a trust that has separately unique and identifiable assets, so let's say you've got a trust with publicly traded securities, but then they also have a business interest in something else or a rental property, you can treat that as a separate asset within the trust and file a separate return for it. But in this case, that's certainly not the case for us. So Part 8, right? This is the 4720 issue. So very first section is self-dealing. So for most trusts, as long as you behave and follow the rules, all of these are going to be blank or NA, right? Not applicable to you. The one time it's almost often the case where you have a yes answer is respect to 1A4, right? So when we look at the self-dealing section, compensation to or pay or reimburse expenses of a disqualified person. So disqualified persons can be a lot of different types of people or entities that are related to or affiliated with the trust. But disqualified person actually does include the trustee itself, even though the trustee might not be a related party. So the compensation paid to the trustee, whom is a qualified person, we do indicate yes. But then when we get down to question B here, it asks us, well, if we answer yes to any of these lines, did any of the acts fail to qualify under the exception in these regulations? And so in our case, we can answer no because we do qualify for an exception under these regulations. And that exception is outlined here, right? So in this Treasury Reg section 53.4941 and change, payment of compensation for the performance of personal services that are reasonable and necessary to carry out the exempt purpose shall not qualify as self-dealing. So that's kind of the way to get it out of here, right? So if the payment to the trustee is a disqualified person, but as long as it's reasonable and necessary in carrying out the exempt purpose, that's okay. You qualify for one of those exceptions, right? Okay, let's go back to the trust return. All right, so some of these other things, again, all these are no for us, but some big ones to keep in mind or be careful of are excess business holdings, right? So did the trusts hold more than 2% of an interest in an enterprise at any time during the year? And that is important because if you're over the 2% ownership threshold, now you have to look at, well, who are the other owners of that business interest? This is often an issue where you have individuals try to contribute closely held stock to a charitable trust. A lot of times it doesn't work. You have this excess business holdings problem. So that's something to keep in mind. Other issues down here, very important, right? Taxable expenditures. So don't get involved in propaganda. Don't get involved in trying to influence public elections, right? These are things that the IRS does not like when trusts get involved in these kind of activities. Okay, so all of the, and the last one, very important, right? So Section 664 trust, that's us. Did the trust have any unrelated business taxable income during the year? No, right? So if we had an investment in, let's say, a pass-through entity, we got a K1 from a partnership, maybe we might have some UBTI. We might have to file a tax return and pay some tax on that. All right, Part 9. Questions for charitable lead, pooled, and CRTs. So this is everybody, right? So all trusts, boxes 1 and 2, right? None of the income interests expired during or before 2022, right? We just got started, so no check boxes there. We are not a charitable lead trust, so we can leave that blank. We are not a pooled income fund, so we can leave that blank. We are a charitable remainder trust, so we're going to fill out this section. Okay, so we've got, ask us if we're filing this, whose charitable interests involve only cemeteries or war veterans posts. All right, and that's not our case here, right? Our remainder is a medical charity. It's not a cemetery or a war veterans post. We're not making any of these elections during the year because we didn't distribute any kind of property other than cash. We just made a cash distribution, so not applicable to us. We don't have any interest in CFCs. We are filing an initial return, so we were checking yes there for question 13. The trust was not amended during the year, so we can check no for there. And then this is not a final year return, so we don't have to answer any of those. We can just leave those blank, right? So it's not a final year return, so it's basically not applicable. And then lastly, question 16, we didn't have any ownership interest in any non-U.S. bank accounts. So we've checked no. We don't have to do an FBAR, which is the FinCEN Form 114. All right, so now we're on to Schedule A. So the Schedule A, couple of parts here, right? So Part 1, accumulation schedule, Section 664 trust, right? So these are the charitable remainder trusts, CRTs, not the lead trusts. So you see that these numbers up here are pulling from the second page, right? So enter the amounts from Part 2, line 3. So remember, if we jump back up to Part 2, line 3 here, the total distributable income for the period. So it's the current year amounts plus the undistributable income carried over from the prior tax years, right? So we've got those amounts entered here, same column, right? So ordinary income, 36,764. It's in the NII column, right? It's not excluded. And then the capital gain or loss amount, and again, item C is non-taxable. The total distribution for the year, that's $47,836, right? That was the UniTrust amount that we saw up here on page 4, $47,836. That was distributed out to the income beneficiary during the year. So there's that number. And then we get down to Part 3 where we look at, okay, the current distributions. So this is where we enter the recipients for those. So for the income beneficiaries, these are the ones that are going to get a K1. All right, so we've got our income beneficiary here, Adam Smith. Remember, that's John Smith's son. So we've got his name, his ID number. The column C is left blank because this is not a UniTrust. Right, so percentage of total UniTrust amount payable, if applicable. In our case, we have a CRAT, right? So it's not a UniTrust amount, so we can leave this blank. Now here's the fun part, right? Figuring out, okay, what gets distributed to Adam, what's the character of it, and then take a look at the K1 and try to bifurcate this column even more, right? So the total amount of distribution to Adam is $47,836. So remember, when we look at the tier system, we have to chip away at each tier in order until it's totally exhausted. So the $47,836 exceeds all of the income earned in the trust during the year. So we know that, well, you know, we can kind of skip ahead almost because we know that all of the income is going to be distributed out, and we even had to dip into some of the principal to cover the shortfall. So we had the $47,836. So if we start here, okay, we used up the entire $7,800. Then we use the entire non-qualified dividend of $93.45. We used all the qualified dividend amount. We used all the short-term gains. And now we have to come up with a little bit of excess to cover the shortfall. And that's where we dip into the principal. So the ordinary income amount that was distributed to Adam was all of it. All of the short-term capital gains went to him. We don't have any amounts of long-term or non-taxable. And then the gap there is the corpus. So the 2571 is the shortfall of amount that had to come out of corpus in order to satisfy the total annuity amount. Remember, with these CRATs, if the trust isn't making enough investment income to cover the annuity payment, that doesn't matter. The income beneficiary still gets that full payment. It just comes out of the income first, but then it could have to dip into principal, and so that's what happened here. Okay, so then in column I, add columns D through H, so we've added up all of those, and that's the $47,836. And they do ask us down here, it's kind of like a check figure, right? If line 3 total in column I, that's this one here, does not agree with part 5, line 1B, right? So part 5, line 1B for a CRAT, or part 5, line 7 for a CRUT, you got to check here and attach an explanation why. What's going on here as to why it doesn't match. So in our case, the $47,836, that does match part 5, line 1B. Right, so part 5, line 1B is the total annuity amount for all the recipients, $47,836. Okay, and then in column J, we enter, well, how much of this is net investment income? So the net investment income up here, right, it's all of these, so the 36,764 and 8501. Why the difference there? Because of principal, right? Principal is not subject to tax. It's a return of principal. So it's not included in the NIT computation. All right. Now, part 4 and 5, so no distributions. So this is for, in part 4, charitable lead trust or pooled income funds only. Remember, we have a CRAT here. We don't have a CLT. We don't have a lead trust, so this is blank. Part 5 is where we include the donor and asset and donor information. So 664 trusts. Those are the Charitable Remainder Trust and Charitable Lead Trust. This is the initial return, right? So we checked yes, right? This is initial return for 2022. And then we have the donor information. So John Smith is the donor. He's the one that formed the trust. The type of property contributed is cash. The fair market value on the date of the donation is $1 million. And then the date of the donation was March 15th, 2022. Now, question 5 for CRTs, if this was the final year, was an early termination agreement signed? In our case, not applicable, right? This is not a final year. All right, and then now we just get into the capital gains, which we've already gone over, and that was the overflow statement. We covered that. Okay, so now let's look at the K1. All right, so now we figured out, okay, we know how much cash was distributed to the beneficiary, how much did Adam get in actual cash, and we know the character of the income now. We know the character of the income, we know how much was short-term capital gain, we know how much was principal, and we know how much should be ordinary income. Now, the short-term capital gain one is easy, right? We can see the 8501 figure there, right? We saw that on the accumulation schedule, right? So we have 8501 in capital gains distributed. Corpus doesn't get reported on the K1, so no issue there. The net investment income, we know that gets reported on the K1. That's pretty straightforward. But the real question here is, okay, how do we separate the ordinary piece? Right, so we can see here that the ordinary income is $36,764, but it comprises interest, ordinary dividends, and qualified dividends. And so that's the part that we have to break out. And so that's where we go back to this sheet here. This provides a little more help because we can see, well, there's the total ordinary income allocation, and these were the pieces, right? So what we did was we took the gross amounts after we allocated those deductions, right? We did that on page 1. We've got the net allocation for each basket, and so we can see now what needs to be reported on the K1. So $7,800 in interest income gets reported, right, up on line 1. So let's look at that. So we've got $7,800 in line 1. Qualified dividend income, 19,619. So there's the 19,619. And then ordinary dividend is the total of non-qualified and qualified. So if you add these two together, you get 28,964. And that's reported up here on line 2A, 28,964. All right, so there's those three pieces. That's the total amount of income that's going to be allocated to Adam, right, for the year. So that's the amount that he needs to report on his personal return and pick up those amounts. The return of principal amount, again, it's just a return of principal, so it's got to be reported on the 5227. But that's the amount that Adam, he basically free cash, I suppose. It's cash that he doesn't have to reflect in his current income for the year. All right, so that covers it for this tutorial. I hope that was helpful. Tried to cover as much as I could, with time permitting here. We've already been going 40 minutes, so I hope that was helpful. If you have any questions, feel free to leave a comment below. I will be posting some other videos on some other different types of trusts, so go ahead and check those out as well. And as always, I look forward to seeing you again on the next video. Thank you.